This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, in Chapter 2, we saw how all the different sources of taxable income would come together and be presented upon that income tax computation. We saw there the earned income, trading profit and employment income, and they are going to be the object of, indeed, several more lectures on the following chapters. Chapters 4 through to 8 will deal with trading profits and, of course, trading losses there as well. And Chapter 9 will deal with employment income. Those are big areas in their own right, worthy of a 10 or 15 mark question, let alone individual objective testing questions for 2 marks. So they're big issues. Back in Chapter 2, we were basically given the figures of each of the sources of income, whether it was employment income for the tax year, whether it was a trading profit, whether it was dividend income, interest income, or indeed property income. Now, in relation to dividends, it's just a simple matter of picking up the amounts received and then, of course, dealing with the way in which those dividends are subsequently taxed. We focused a lot on savings income as well. The interesting things about savings income, though the sources of savings income are very obvious, the different types of interest income, and they're assessed as with dividends on a received basis. It's a simple enough system. The real interest with, again, we keep using the interest pun, don't we, on savings? But the real interest there was to do with the way in which it was taxed, whether or not savings income would benefit from the 0% starting rate, depending on your tax status as either basic, higher or additional rate, what, if any, would be the savings income nil rate band, and if we went above that, what further then would be the tax rates to apply. So we focused on the taxability of non-savings, savings and dividend. Well, one other form of non-savings income, a source of investment income this time, is property income. And indeed, we looked at property income in some detail, not looking and focusing, worrying about the basis of its assessment, which you may recall is for us from the 18-19 tax year, a received basis, but looking at its flexibility in terms of planning. The idea of either one spouse or both spouses jointly owning a property from which property income was then derived. We looked at the planning opportunities that existed to try to move income out of a higher rate back into a lower rate, or indeed back into no rate at all, where you'd otherwise have had an unused personal allowance. So it lent itself to planning type problems. Again, I trust what you call what we did there, both within Chapter 2 and our references through to Chapter 26 as well, on the tax planning side of questioning. We're now going to look in more detail at how we derive that property income assessment. When we look at property income, we'll see here that it comes in 2 main forms, one of which we're obviously familiar with and probably the only one we would have thought of with a property, and that's rental income. So we've got rents, therefore, rental income that will be received under any lease or tenancy agreement. An issue that you probably haven't seen before is that when a lease is granted, a short lease here, one of not more than 50 years, when a lease is granted, what may happen, in addition to rental income being receivable over the entirety of the lease period at no doubt renegotiable levels every 5 years, 7 years, whatever you want it to make it be, where rents will be reviewed. But what may also happen is at the very beginning of that lease period, the owner of the lease may be able to demand from the lessee, the tenant there that will take up that occupation of the property, a premium. Now, it's not normally seen in relation to residential property for individuals. Normally where this will happen is when dealing with businesses as a tenant, whereby the landlord, the lessor, may have incurred some improvement costs at the request indeed of the lessee, and those costs are then basically returned to the owner, the landlord, the lessor, not via an increased rental, but via a premium payment up front. And often what is happening here as well, it may be that given the popularity of a particular venue, that the landlord is again able to charge this so-called premium. Now, you don't have to worry about how it is derived All you've got to worry about is how do I deal with it from a taxation perspective. And very obviously, some part of that premium, if not its entirety, is going to fall assessable to income tax here for individuals, in corporate tax for companies, to corporate tax there as property income. The question mark will arise, and we'll solve this chapter, as to how much of that one-off premium will indeed be treated as income. So more of that later. But by far the more obvious one, rental income. And it may be the only one indeed. In the vast majority of questions do not include those premiums on the granting of short leases. But you'll certainly have to deal with rental income, especially as for the 1819 tax year, the basis of assessment has changed. Now it's been simplified. What used to happen, again noted here, income from land and buildings prior to 1819 tax year, so up to and including the 1718 tax year, was computed for individuals as if the letting of the property was a business. And of course, businesses work on an accruals basis. So the amount assessable in the tax year was computed as the rental income accrued, less allowable expenses incurred. The accruals basis, what we use for businesses, therefore. But now for individuals, companies will still operate the same system of an accruals basis in their corporate tax computations. But now for individuals, as we'll discover here, we now apply a simple cash basis. It's far easier for an individual who happens to have property income, knows nothing about business, knows nothing about the accounting system and financial statements, to simply work on a receipt basis. So they've made life easier for taxpayers to determine what will be their income tax assessment within any tax year. So we'll work on a simple cash basis. And we should assume here that the cash basis, again an exam question, should be assumed to apply unless you're specifically stated to the contrary there. Now, again, why would that be the case? Well, a taxpayer may in fact choose to continue to use the accruals basis, or then must use, no choice here, use the accruals basis where property income receipts exceed £150,000. Yeah, this is, as it were, big business here in inverted commas if you've got a rental income of £150,000 or more. But for the individual with maybe a few thousand, tens of thousands there, but not hundreds of thousands of income, it's going to be so much easier. Simply to pick up the rental income actually received in the tax year, you can look at your bank statements, you can see when the money came in, and then on expenses, when did they pay out, when did the money go out. It'll be a far simpler system for individuals, and hopefully, of course, for us as well, so far as exam questions are concerned. Now, of course, wherever things change within the tax system, it's an obvious target so far as the next round of examinations are concerned. But given that we've got so much objective testing within the exams these days as compared to the system of years gone by, then of course with objective testing you're probably always going to see at least one 2-mark exercise to deal with property income, if not more, and that is not going to change now. So we're definitely going to see this in our exam. So therefore, on the cash basis, an assessment will now be rental income received less allowable expenses paid. More of what the allowable expenses are in a moment's time. But nice and simple, we're working on a paid basis. So it does not matter now from 1819 onwards whether or not the amounts were payable in arrears, in advance, whether it was, again, whatever basis, 6 monthly or 12 monthly or quarterly or monthly. What we're going to pick up is the actual amounts received. But we've got to interpret what that means when given information within a question. And that's what we have here with example 1. Jim bought a property and rented it out for the first time on the 1st of July 18. So remember, we're dealing with the 1819 tax year. And of course, again, the requirement to compute the property income assessment for this year and also compute the assessment if the taxpayer chose to use, as is still their right, the accruals basis. Now, unless you were given that information about using the accruals basis, we will assume indeed that the cash basis now will apply. What we solve here? we've got rental of £6,000 per annum, which is to be paid to Jim, alternatively either quarterly in advance or quarterly in arrears. So in terms of that rental income, whether in arrears or whether in advance, what we want are the amounts received. So if it was quarterly in advance, well, it starts on the 1st of July of 2018. That would be one amount received, followed by it's quarterly the 1st of October of 18, followed by the 1st of January 19, followed by the 1st of April. Oh, very appropriate to make that mistake on the 1st of April. Yes, a fool's error. So on the 1st of April, this time of course January and April 2019, those amounts were received. Now, in which case, quarterly in advance, we've got 1, 2, 3, 4 quarterly payments. Now, of course, 4 quarters in the year, it's the full 6,000. But at £6,000 per annum due quarterly, that would be £1,500 per quarter. 4 receipt dates arise there, so 4 amounts, a full £6,000 would have been received. As you see when we'll go through the answer in a moment, what they may do in a question, and probably would do in an exam question, a slightly more testing one, is to say pick on that particular amount due that was due there on the 1st of April. And they might put a little line in the question saying that the amount due to be received on the 1st of April was not actually received until the 10th of April, the 15th, the 8th, the 20th, whatever it might be. But a date after the 5th of April 19, i.e. it doesn't fall in the 18-19 tax year, that's now gone into and been received in the 19-20 tax year. So it is when it is received that would count here. So assuming that the amounts, as we have to assume, given this information, were received on the due dates, were received 4 quarters, £6,000. If the amount due on the 1st of April was not received until after the 5th of April 19, then we'd have only received 3 such quarters, £4,500 would be the amount received. If it was quarterly in arrears, well, we started renting it out on the 1st of July, so 3 months later, the 30th of September 18, followed by the 31st of December 18, followed by the 31st of March there of 19. The next due date, the 30th of June of 19, is in the 19-20 tax year. So that would mean there 1, 2, 3 quarters at £1,500 a quarter, and that would be £4,500. Again, they could say that the amount that was due to be received on that 31st of March date, being the one closest to the end of the tax year, again was not actually received until some date post the 5th of April. Therefore, it wasn't received in our 18-19 tax year. That would have left just those 2 receipt dates there in the tax year, and instead of £4,500, it would be £3,000 that was actually received. So look out for information, not just about the basis of when it was due, and whether that was quarterly, whether it was monthly, whether it was annually, whether it was half yearly, and then whether or not those amounts were actually received on the dates so due. What was actually received for us within our tax year. Also watch out, of course, if the rental only started part way through the tax year, such as this one being their 1st of July 18. Okay. Then as regards our expenses, let's get rid of that information there. Paid basis. He paid allowable expenses, more about allowable deductions down here in section 1.2, of £300 in November 18. Is November 18 within the 18-19 tax year? Yes, it is. So that amount is paid. That is a deduction this year. Redecoration, as we'll see in the notes below, any repairs, redecoration work that is done on the property, that's going to be fine. That will be a revenue expense and will be allowable. So that £500 is an allowable expense. But it was paid there in May 2019, even though the repairs themselves were completed in March 2019. So the fact that they were actually done, the expenses were incurred within the 18-19 tax year, is no longer an issue from 18-19 if we're working, as we will now automatically assume to be working, unless stated to the contrary, on a cash basis. So that £500 figure will be paid in 1920, and therefore it will feature in the tax year of assessment 2019-20 there, not 18-19. So all we've got to do, therefore, is to put those figures together of what rental income was received, less the expenses paid, based in terms of rental income received anyway, on whether the amounts were received in advance, in arrears, and whether or not payments due at the 31st of March 19 or the 1st of April 19 were actually received at that date, or at least by the 5th of April 19. If received after that date, they're not in this tax year, they're in the next tax year. Now, it also said here for us to work the accruals basis. Now, it's not likely that you're going to have to work this accruals basis here. In terms of an individual, you will, of course, have to work an accruals basis so far as corporate tax is concerned. But it shouldn't really hold any great problems for us. Now, again, what do we mean by that? Let's wipe the slate clean as regards our little example. If we're talking the accruals basis, we want the rental income accrued less the allowable expenses incurred. Well, the rental income accrued there. The rental period started on the 1st of July 18 and went through past the end of this tax year, but for our tax year 18-19, from the 1st of July 18 to the end of the tax year, the 5th of April 19. Now again, we do our apportionments here to the nearest month, so that therefore is 9 months. We got 6 months in 2018 and the first 3 months worth of 2019. So it was £6,000 per annum, and irrespective of that information, doesn't matter, on the accruals basis, annual is £6,000. We've got 9 months in relation to the period from the 1st of July 18 to the 5th of April 19. So that would be times 9/12. 9 months worth of the 6,000, that would be 4,500. Irrespective of whether or not it was in advance, in arrears, irrespective of whatever dates the cash may have been received on. So that was it, it's a received basis. In relation to expenditure, then we've got expenses, therefore, that were incurred in and paid allowable expenses under November 18 for redecoration, again presuming that work was done, and £500 in May 19 for repairs completed in March 19. May 19, there was paid, repairs completed in March 19. So on the accruals basis, had we incurred the cost by the end of the tax year? Yes, we had. March 19, that's in the 18-19 tax year. So in fact, both the £300 and the £500 would have been incurred during the tax year and would be allowable deductions from your 9/12 of the annual rent, your 4,500. So we'd be deducting the 800 from that. Okay, now I talked you through that. Hopefully, again, you are familiar with those workings. Do now please check out the answer to that in the answers in the back and make sure you're happy with the answer to the question as it stood and the additional points that I've discussed as we've gone through, basically concerning with what would have happened if those amounts due towards the end of the tax year weren't actually received until the next tax year, because that's the typical thing that the examiner would do in an exam question. Okay, so just pause for a moment while you take a look at the answer, read, review through it, make sure you're happy with that. Okay, hopefully you're happy now with example 1, pardon me, and we can continue through to look at, well, rather more detail about the allowable deductions. Now, we know that any allowable expenses that have been paid within the tax year will be allowable deductions. We're working again on a paid, not an accruals basis any longer. So what sort of expenses are we looking at as being ones that would be allowable? Well, there's a generic rule overall, which is applicable not just to property income assessments, but also to trading income assessments. And that is that expenses must be incurred wholly and exclusively here in connection with the business. That's the idea of the property there, the property letting, that being a business. When we look at the next chapter, chapter 4, we'll see there that the generic rule of allowability of expenses reads the same, that it must be incurred wholly and exclusively for the purpose of the trade. Here it's wholly and exclusively in connection with the rental of that business, of that property there. Typical ones to see. Insurance costs. Yeah, you're going to insure the property, of course you are. Any such insurance costs, remember now, paid in the tax year, will be allowable deductions. You'll incur agents' fees. Again, rather than managing the property yourself, you may well choose to use a managing agent, and they're going to take a percentage of your rental income that you would receive each month, each quarter, each whatever basis period you may have for the collection of the rent. They'll take their 6%, 8%, 10%, whatever it was. That, of course, is an allowable expense that we have incurred. Other expenses associated with the management of the property. There might be cleaning expenses that we incur. Pardon me again there, sorry. Cleaning expenses. Certainly what would happen if, for example, part way through the tax year, one tenancy came to an end and the tenant left. Prior to trying to get a new tenant to come in, you may incur some cleaning expenses, getting specialist professional cleaners in to make the property look as good as it possibly could do so you can get the highest possible rent in relation to letting to the new tenant. So those, again, on a paid basis are allowable expenses. Repairs and redecorations there. Now, what we'll see in a moment, and it's something that's true, again, not just with property income, but with trading income as well. What's going to be allowable as an expense against income is going to be revenue expenditure, not capital expenditure. Again, if we look down here at the next note, capital expenditure is not allowable. But this one here that we're referring to, sneaking back in, I can bring the screen down there, repairs, that's fine. Repairs are allowable revenue expenses. Repairing, putting it back into working condition, redecorating there. Again, it was painted, it was decorated, and now after time it needs to be redone, to be put back into that same reasonable good condition. It's not an improvement, an enhancement on the property. Capital expenditure would be, for example, you choose to put a conservatory on the back of the house. So you build an extension on, you build a garage at the bottom of the garden. Those are capital costs that you would be incurring. Now, those will not be allowable expenses to go against your income. Now, you might think, well, that's a bit harsh because they're proper costs to do with the property there. They're obviously making the property more valuable there than it would otherwise have been. And that's where you will see eventually relief given for those capital costs. Because when you sell this property, whether it's next year, 5 years, 10, 20 years from now, you'll have to work out a capital gain on the disposal of this rental property. A capital gain that will be subject then to CGT, which we'll see in our CGT section from chapter 12 onwards there. So any capital costs that you incur, so not just the fact that you originally bought it for £200,000 and 5 years later you sold it for £280,000, if in the 5 years in between you'd spent £20,000 on capital expenditure, building that conservatory, putting on that garage, that extension, whatever it might be there, then that as a capital cost would mean when you compute the capital gain, instead of being sales proceeds £280,000. Apologies if I haven't remembered the right number. But if it's 280,000, instead of that 280, less the original cost of 200, and that was it. But the original cost plus any other enhancement, i.e. capital improvement expenditure. So improvements are capital and therefore disallowed. Disallowed here on an annual basis in working out your property income, but allowable eventually as a capital cost in computing any capital gain that will be separately chargeable to CGT. Just back up here, down repairs. Not that there'd be many of these, but motor expenses here that you incurred by the taxpayer in terms of what you might have to do is you go and visit the properties on a regular basis. You don't live there, obviously it's a separate rental property that we're talking about, and you drive X number of miles to visit the property to check it out and then back again. That, rather than trying to claim for some actual figure of motor expenses incurred, which one could try to do, but that's going to be difficult trying to work out. So what would be the actual expenses there? There's a far easier basis that now we will use here. Now, they are HMRC approved mileage allowances. See Chapter 9. Chapter 9 is employment income, and where you're far more likely to be doing business travel is in the context of your employment. If you're using your own car for the employment that you do, then an approved mileage allowance that can be paid to you, the employee, by the employer without any tax implications arising is 45 pence per mile. They've now adopted for property income that same level of 45 pence per mile. Now, in any exam question, you'd be told how many such miles had been done, times 45p, and that would be the allowable deduction to go against here your rental income received. Probably one of the main expenditures most individual owners of rental property would have would actually be a finance expense. Interest on a loan to purchase or indeed improve or even repair if it was a major expenditure there. If you borrowed money to invest in that property, you're going to be paying interest on those borrowings, and that finance expense, until a couple of years ago, was all a perfectly normal allowable deduction against property income. But that changed from the 1718 tax year and has changed again. It's a progressive change that we're seeing that we'll talk about in a moment's time, that now has to be put through. So we don't now get all of the expense allowed against the rental income, the cash received. Not all of it now goes through. How that works, we'll see in section 3 below. But that's sort of an important change that has occurred regarding the assessment of property income and may impact seriously on many multi-propertied and highly geared, lots amount of loans taken out on their properties there, taxpayers. But prior to these changes, every figure of pound of expense incurred in finance expenses, basically interest paid, would have been an allowable deduction against the income. What has now happened to that is the system for dealing with it has changed, and only some of it is actually allowed as a finance expense, and some of it, such as we'll discuss in section 3 later, is treated as a tax credit, a reduction in tax. But we deal with that, as I say, in section 3. So that's an important one. We've already distinguished between capital expenditure and revenue expenditure. If you did actually incur expenditure on plant and machinery used for the maintenance of the property, a lawnmower, for example, there to cut the lawns of the property, then something called capital allowances. It's the capital allowances we'll see in chapter 5, and it's a huge area and really important area. It's mostly to do with not property income, but to do with trading income. The traders, when they buy plant and machinery, what will happen in the financial statements is we'll incur a capital cost and we'll show a depreciation charge in our statement of profit or loss there to go against the income of the period. that would be the expense depreciation. Well, for tax purposes, depreciation, as you will discover, in fact, in next chapter, chapter 4, is not an allowable expense. It's disallowed in what is called the adjustment of profit procedure for traders, for the unincorporated trader. It's disallowed. And instead, don't worry, it's not all bad news here. What happens is HMRC have devised their own system by which, for all taxpayers for whom it is relevant, all taxpayers will be able to get tax relief for the qualifying capital expenditure on allowable plant and qualifying plant and machinery. So rather than everybody doing it their own way with depreciation charges, it's a set system by which the capital allowance system gives tax relief for capital expenditure incurred. You're probably not going to see this in terms of property income, but that's a possibility. It's like a lawnmower there, plant and machinery there. Again, we use it for the maintenance and upkeep of the property, be capital allowances. Where you are definitely going to see capital allowances, because it is in every examination. I know we don't see much of the exams these days in terms of what's revealed to us, but it's going to be there. I cannot imagine a single exam that doesn't test in some way, shape or form capital allowances. It is such a fundamentally important area. But we deal with that in chapter 5, so to look forward to there. Okay, but there's that small possibility of capital allowances here. Okay, we've then got one final area to look at, and it's to do with residential lettings. Often property, certainly in the UK, is more usually let on an unfurnished basis for long periods of time, for tenants who are going to be there for 12 months, maybe 24 months or longer. But what you might have is residential lettings that are either partly or fully furnished. Now, residential as compared to commercial. We have separate rules for commercial property. If we've got residential lettings and they're either partly or fully furnished rather than unfurnished, then tax relief is usually given for the furniture and furnishings by, here's a lovely term, replacement furniture relief. Now, it's a little bit complicated, this, and will take a little bit of time for you to study and to work through on examples to make sure you got your head around it. What does this mean? Replacement furniture. Well, there's the first point. There is no relief for the initial cost of furniture. So when you initially buy something to go into the property, now these might be things like a freezer, a fridge, a washing machine, a cooker there. When you buy those items, that initial cost is not an allowable expense against property income, because we're talking about replacement furniture relief as where we get the allowable expense here. So there's no relief for the initial cost of the furniture and furnishings. There is only relief when assets are replaced. But when we're replacing, are we replacing on a like-for-like basis? Because that comes into it too. This will include furnishings such as carpets and curtains, electrical equipment such as TVs, fridges, freezers, washing machines, and even cutlery and crockery there would be involved. But how do we work out what that is? Now, you'd think if we had originally bought a refrigerator, a fridge, for the property that cost £400, that initial cost would not be allowable. If some years later we replaced that fridge with one that cost £500, that would be your replacement cost. That is the allowable expense. There's a couple of things that might actually bring that figure down that now we need to be aware of. The amount of relief is reduced by any proceeds from selling the old asset. So we originally bought for £400, we sell for £80. That £80 will be deducted from our replacement cost of that item. So we bought for 500 and we've got back on the old one that's now being sold off, replaced, £80. So you take the 80 away from the 500. But will it be that 500? Because there's another point as well here. So to begin with, any proceeds from selling the old asset which has been replaced, and relief is not given for any cost which represents an improvement. For example, here's my fridge example. If a fridge is replaced with a fridge freezer, cool, we're getting very domesticated here, aren't we? Well, that's an improvement, isn't it? That's not like for like. That is an enhanced and improved asset. And on that basis, therefore, we're not going to be able to get relief for the 500 less your £80 proceeds. It'll be something less the £80 proceeds from the old one, but what that something is, only the cost of an equivalent fridge would qualify for relief. Not the fridge freezer actual cost, but the equivalent fridge qualifies for relief there. Again, you can understand it's going to be fun and games in real life. What would that be? What would the equivalent be? The model that you've originally bought, that you've now sold, might not even exist now. Not your problem in the exam. They're going to have to tell you those words will be used, that an equivalent fridge, cooker, TV, washing machine, whatever it might be, would have cost this. That's the figure you use. So in my example, where we had bought this fridge freezer for, if it were one, for £500, and the equivalent fridge, so that which we had just sold, the original one sold, would have cost £440, we're going to use the £440 instead of the 500. But of course that 440 was to be reduced by the proceeds that you got from the sale of the old one. So the 440 less, I think it was £80 I said a moment ago, that would be 360. Okay, so that's a little tricky, that one. Don't worry, in example 2, you're going to be having a go at an example on that. This rule as regards replacement furniture relief does not apply to something called furnished holiday lettings, because the cost of furniture and furnishings in such properties does qualify for capital allowances. Now, there are also various specific rules that pertain to that very special type of property, furnished holiday lettings. So watch out for that word holiday. We'll be looking at that in a later lecture, just a wee bit later on in this chapter. Relief is available for revenue expenditure incurred before letting commenced under what's called the pre-trading expenditure rules. Again, some of the expenses we incur may have been incurred prior to actually getting a tenant into that property. We'll incur expenses while we're trying to rent that property. We'll incur expenses between rental agreements there from one to the other. It comes under the overall rule of the pre-trading expenditure rules when you start to trade. Chapter 4, Adjustment of Trading Profits. When you start to trade, you can't just start to trade on day one. You're going to be incurring expenditure before the actual trading starts. And what it says here is that basically, if you've incurred what would have been allowable revenue expenditure up to 7 years prior to renting, it's treated as being incurred on day one of the letting business. Now, it's not so likely here, but it's something that we'll be revisiting when we look at trading income. Okay, well, there is example 2. I'd like you to have a look at that and have a work through that. I will go take you through that at the beginning of our next lecture together when you come back to us for that next lecture. But I would like for you to have had a go at that yourself, having firstly spent time going through and studying the points that we've dealt with here within this particular part of the chapter. So work that through, and I look forward to reviewing that with you and then moving on to deal with the other parts of property income assessments.